How much money can you save for retirement if you're self-employed? What did I learn from a mistake that will easily cost me more than $100,000? And are subsidies under the Affordable Care Act now illegal? We'll answer these questions and more on this, the 91st episode of the DoughRoller Podcast.
Welcome to the DoughRoller Podcast, where the best thing money can buy is financial freedom. We help you make more, spend less, and invest the rest. And now your host, Rob Berger.
Whether you're just starting out, buried under a mountain of debt, or well on your way to financial freedom, this is the podcast to help you take your finances to the next level. Hey, everybody, this podcast is sponsored by Betterment, the most preferred automated investing service. Betterment has cutting-edge technology to optimize returns, minimize taxes, and save you time and money. Join over 34,000 customers who have already streamlined their portfolio management at betterment.com/roller. That's betterment.com/ROLLER. Well, have I got a story for you today, and it's not a pretty one. I'm going to definitely share one with you. Some costly mistakes were made, and I'm going to share with you what they were and what I learned from them. Kind of painful, frustrating. You'll hear about it in a minute. I think it's important to share this kind of thing because this is, life. It's what happens, with finances. Things they really weren't complicated. This mistake should not have happened, but it did. And what I need to do now is learn from it as best I can and then move past it. But it's an expensive one. So we're going to talk about it today. Before we get to that, though, a couple of things. First of all, if you haven't signed up for the weekly newsletter, I encourage you to do so, DoughRoller.net/newsletter. It's a newsletter I send out via email every Saturday at 7 p.m. It gives you links to all the articles I've written that week on DoughRoller, as well as articles I've written elsewhere, like at Forbes and Huffington Post and U.S. News. But I also link to other stuff, too, that I just find around the internet that week that I think are useful, whether it's about managing your money, investing. Sometimes it's just some fun stuff, at least fun to me, that I find interesting articles about all kinds of things that I put in the newsletter. So it just goes out once a week. And again, you can sign up for that, DoughRoller.net/newsletter. Also wanted to give a shout out to Nick M. Nick emailed me. I had a podcast about the Morningstar portfolio monitor and mentioned that it's only for those that have the premium membership at Morningstar. That was in podcast 86, DoughRoller.net/podcast 86. Nick pointed out that if you're with Merrill Lynch or Merrill Edge, I guess, you may be able to get a free membership to the Morningstar Premium service if you're with them. So I wanted to mention that. And Nick, I appreciate you sharing that with me. I love to get your tips like that and pass them on to everybody so that everyone can benefit from our collective knowledge. It's a great thing. The other thing I wanted to mention before I get into my sad story is a couple of decisions from two appeals courts, U.S. appeals courts, one from the Fourth Circuit, which is in Richmond, Virginia, and one from the D.C. Circuit, which, of course, is in the District of Columbia, that came out yesterday regarding the Affordable Care Act, and they reached opposite conclusions. And it's a pretty significant issue. As you may know, under the Affordable Care Act, some folks, depending on income, are eligible for subsidies, and they're quite extensive subsidies. And the way the statute is worded, it says if you can get subsidies if you qualify, but you have to. They can only be offered through state-run exchanges. Well, as you may know, I think it's 36 states decided not to set up their own exchanges, and so the federal government stepped in, and this was part of the statute. The federal government stepped in and ran the exchanges for them. Well, that presents a problem, of course, because the statute is pretty clear that you can only get the subsidies if you buy your insurance through a state-run exchange, not an exchange run by the federal government. And that would mean that folks in 36 states would not be eligible for subsidies. So what did the IRS and the Obama administration do? Well, they just said, no, we're going to make subsidies available for everyone, whether you sign up through the state exchange or the federal exchange. Well, many lawsuits were brought on this, not just the two that were decided yesterday. And but they basically said, no, you can't do that. The statute is clear. It says you're going to get subsidies if if you sign up through a state-run exchange, which would effectively mean that folks in 36 states would be out of luck. Now, at first, that may seem odd. It's like, well, why would Congress do that? Well, it's actually not odd, and it's not unprecedented either. The theory behind it is they want to encourage the states to set up their own exchanges. So you say, well, if you set up your own exchange, then the citizens in your state, folks will get substantial subsidies. So it would encourage states to set up their own exchanges. Medicaid has a similar component where states have to participate to get benefits. So it's not an unprecedented thing for Congress to do. And in the statute, it's crystal clear. Of course, the problem is 36 states did not set up their own exchanges. And so just like a number of states did not expand Medicaid, which was another pretty significant component of the Affordable Care Act, the Affordable Care Act effectively said you have to expand Medicaid, and the Supreme Court said that's unconstitutional. Federal government, you can't require states to do that. That was in a different decision. So anyway, these two decisions came out yesterday. The D.C. Circuit said, yeah, the statute is what the statute says. It says you have to sign up through a state-run exchange, and we recognize that this decision is going to be very painful, but it's not our job to, our job is to interpret and apply the statute, not to avoid pain for people. And, and if Congress wants to go in and change the statute, they can. It's, the courts didn't rule they couldn't change the statute to read differently. It's just that it's not how the current statute reads. The Fourth Circuit down in Richmond went the other way and said, well, yeah, it says states, but that's probably not really what they meant. They probably meant it could apply to the federal exchanges too, which is an interesting decision because, that raises the question, is that the job of a court to say, well, yeah, you said one thing, but you probably meant to say something else. The reality is judges do that all the time. Well, at least some judges do. So anyway, that raises a pretty interesting showdown between the Fourth Circuit and the D.C. Circuit. The way these things normally get resolved, of course, is with the Supreme Court. Now, the Supreme Court doesn't have to take a case. You petition the Supreme Court to hear a case. They can say, no, we don't want to hear it. It's up to the Supreme Court. When there's a conflict between courts of appeals like this, particularly on an issue this significant, they almost always take it up. Now, in this case, what's going to happen with the D.C. Circuit is they're going to be asked to hear the case, what's called en banc, which is so at a court of appeals, three judges hear a case, but then once it's decided, typically the losing party, right, can say, let's have all the judges on in this court, because in any court of appeals there might be, I don't know, let's say a dozen judges on the court. Let's have all 12, let's say, hear this case, and that they can do that, and they will do that, and so that decision could get reversed en banc. Although even if that were the case, there would no doubt be a petition to the Supreme Court, and even without a conflict within a courts of appeal, they could still hear it. It's a pretty significant case that relates directly to statutory interpretation and the power of the administration to interpret that statute. So at the moment, though, it kind of throws a pretty significant part of the Affordable Care Act into a state of a bit of uncertainty. So that will be an interesting issue to follow, particularly, by the way, if you or someone gets subsidies and you happen to live in one of the 36 states run by healthcare.gov. The other interesting implication is that when subsidies when the government pays subsidies, it automatically triggers certain taxes. And so that raises the question as to whether all these taxes were illegal as well. So it's a very significant issue, and it will be interesting to follow it. I have absolutely no predictions as to how it will turn out. Every time I've tried to predict a Supreme Court decision on the Affordable Care Act, I've gotten it terribly, terribly wrong. So I'll just stop predicting, and we'll just watch and see what happens. Okay, enough law school for one day. Let's move to my sad story. I think that's what I'm going to call it from now on, my sad story. So here's the deal. When I started this blog in 2007, it was just a hobby. Still is, really. But over time, it started to get more and more visitors. I mean, it gets, the blog gets, I don't know, I have to look it up, but, a couple million visitors a year now. And so it gets a lot of traffic, and it started to make some money. So I, on the recommendation of a friend, I found an accountant and to do my taxes and help me with tax planning. One of the things I learned is that if you're self-employed, you have a lot more options when it comes to saving for retirement. You're not just limited to, say, a 401k at $17,500 or an IRA at, say, $5,500. You can open up either sort of the two most common, I think, are either a SEP IRA or a solo or individual 401k. And depending on your company's income, you can contribute substantially more than what most folks are used to in a 401k or an IRA. And then for 2014, that number is $52,000. That's a big difference. Now it does depend on how much income your business generates. So it's a $52,000 or either 20 or 25% of your income, whichever is less. It depends on whether you have the SEP IRA or the 401k. As to whether it's 20 or 25%, but the point is you can, in theory, contribute a lot more money to a SEP IRA or a solo 401k if you're self-employed or have your own business, as compared to employees either with a 401k or an IRA. Big difference. So I was stunned to hear that. I had, before that, I had no reason to even think about the options for those that are self-employed. And so never really given it much thought, but my accountant pointed all this out to me, suggested I open up a SEP IRA in 2010. So I did. Now, one of the things he told me was, and I forget what the limit was then, it wasn't $52,000, but it was maybe high 40s, 48, 49. It goes up a little bit each year, not unlike contribution limits for an IRA or 401k can go up a little bit each year. So one of the things he told me then was, yeah, that's the limit, but you have to subtract from that limit the amount you contribute to your 401k at work. So I think back then, 2010, I want to say the limit was around $16,500, I think, for a 401k. So if the limit for the SEP IRA was whatever, let's say $48,000, $49,000, you first had to subtract whatever you contributed to your 401k, and that was your limit for the SEP IRA. And I always maxed out my 401k at work, so fine, I subtract the $16,500 back then from the SEP IRA limit, and that was how much he said I could put into the SEP IRA. All right, fine. Didn't even really give it a second thought. Well, that's what I did for 2010, 2011. You know where this is going already, right? 2012, 2013. Well, in 2014, I realized a mistake that I had made. Now, this isn't the sad story mistake. This is a different mistake, and that was I hadn't been taking advantage of a backdoor Roth IRA. So if you've listened to these podcasts, I've talked about the backdoor Roth in episode 40. So you can check that out, DoughRoller.net/podcast40. Basically, it's for those folks that can't contribute to a Roth 401k or IRA because of their income, and maybe they can't even deduct a regular contributions to a regular IRA because of their workplace retirement plan and their income. So what they can do is they can contribute after-tax dollars to a regular IRA and then just immediately convert it to a Roth. You can convert IRAs to a Roth. And since you're contributing after-tax dollars, the conversion shouldn't generate any taxes. And now, basically the effect is, rather than simply putting this money in a taxable account where you'll have to pay taxes on the dividends and eventually taxes on the capital gains, you can put it into an IRA, convert it to a Roth, and then it grows tax-free. Well, I hadn't been taking advantage of that. I wasn't aware of that option, which I'm really embarrassed to say that, but it's true. And I was disappointed with my accountant that he hadn't, we talk about tax planning every year. He'd never mentioned this to me. And in a recent email exchange with him, I learned that he didn't even know what a backdoor Roth was, which well, we'll come back to that in a minute. So here's the deal. If you've listened to episode 40, you know that when you convert an IRA to a Roth, you have to take into account all of the IRAs that you own, any rollover IRAs, any SEP IRAs, in determining how much of the conversion is taxable. So I couldn't just put $5,500 in after-tax money into an IRA and then convert it and pay no taxes, because they would take a pro rata. They would look at all of my IRAs. It's almost as if, I might have them in separate IRAs, even separate brokers, but the IRS would look at it as one big pot of IRA money in determining how much of that conversion is actually taxable. So what I was going to do was take my rollover IRA, my SEP IRA, and move them into an individual 401k, which is a pretty standard thing to do when folks want to take advantage of a backdoor Roth. So get them effectively out of an IRA. So then the only IRA I have is the after-tax IRA that I want to convert, and then no taxes. Hope you followed all of that. If you didn't, check out podcast 40 for more details on that. But the point is this. I was on the phone with Fidelity about doing all of this. By the way, I would probably do it at Vanguard, but they don't allow you to roll over IRAs into a 401k, something I really wish they would change. Fidelity does. And we were talking about the SEP IRA and the 401k, and the retirement specialist on the phone said, well, the limit will be $52,000 for either one. As far as the what they call the employer contribution. I'm self-employed, so I'm the employer. But I said, well, yeah, but you got to subtract the 17.5 in 401k contributions that I make at my day job, right? And he goes, no. Pause. I said, well, what do you mean no? Yes, you do. My accountant since 2010 has told me you have to. He goes, no. Are these are totally separate companies? I said, completely separate. I mean, my self-employed income is basically just from my hobby, totally separate from my day job. He said, yeah. If they're totally separate, you don't have to. He said, the 17.5 that employees contribute, that is per person. So that's all you can contribute, regardless of how many 401ks you belong. You could have 30 different jobs with 30 different 401ks. You can only contribute a total of 17.5, period. But the employer side of the contribution is not per person, it's per plan. And a SEP IRA, the contributions are considered from the employer. And even with an individual 401k, there can be employee contributions, but there can also be an employer match, again, up to $52,000. And that's per plan. So no, sir, the 17.5 you contribute to your 401k at work does not affect the limitations for how much you can contribute to either a SEP IRA or the employer contributions of an individual 401k. Well, I was just stunned. So immediately I went to the internet and was researching this. Not that I didn't believe the good folks at Fidelity. I mean, if you figure if anyone's going to know this, it'd be them, right? Or maybe a tax accountant that you hire. So I go and do the research, and sure enough, I confirm that Fidelity is right. And what does that mean? It means that I have not been contributing the maximum to my SEP IRA since 2010. So I email my accountant, and I think, well, I'm not going to tell him this whole story because I really want to make sure I get this right. So I'm just going to ask him the question, and he has an assistant that does some research, and she comes back with an email and says, no, you have to subtract the 17.5. Exactly the opposite of what Fidelity tells me. And she cites two articles, one of which I'd already read from the IRS as part of my own research. The other one I had not read. So I then responded and kind of told him this whole story, explained why the two resources they've cited I don't think address the issue, and cite another 4 or 5 resources that I found on my own. Long story short, they come back and say, you know what, we've looked at all this and you're right. The 17.5 that you contribute to the 401k at work does not affect the SEP IRA limit of $52,000 or the employer match of a solo 401k, which also happens to be up to $52,000. Again, it's also limited by the amount of income your business makes. So now what do I do? Well, this brings me back to episode 89 of this podcast, just 2 episodes ago, where I talked about the 12 keys to making smart financial decisions. And I talked about taking responsibility for your finances and your decisions and being honest with yourself. And so I thought, well, I recorded that podcast. I published it. Maybe I ought to, take my own medicine and think about what I can learn from this. And I thought about my situation with my accountant. And I looked back and said, well, what role did I play in this? I didn't obviously give the wrong advice. And when, I started contributing to a SEP IRA, I had no idea what the rules were. And I just simply took his advice at face value. I didn't question it, didn't examine it, didn't go do my own research. I just accepted it. But as I thought back on my history with my accountant, I realized that there were signs that when it came to, I don't know that I consider this a complex tax issue, but it's maybe not the kind of situation that small tax firms encounter every single day. His advice wasn't very good, and I'll give you a couple of examples. Back in ironically, the same year the SEP IRA started, 2010, someone offered to buy my blog from me for a fairly significant amount of money. And obviously, I decided not to sell it. But at the time, I asked my accountant to assess for me what the tax consequences would be of a sale. And the primary question is, would it be treated as capital gains or ordinary income? And the tax difference there can be quite significant. Not as significant as it used to be, but still nevertheless significant. And he came back and said it would all be taxed as ordinary income. And I asked why. He said, well, because you created this website from scratch. You didn't buy it from anyone. So that's true. I just got a domain name. That cost $10. WordPress, which is the software that runs most blogs, is free. And I started blogging. So yeah, my capital contribution was $10. And he said, yeah, so basically it's free. I said, well, okay, it's $10, but fine, it's basically free. He said, so therefore it's all ordinary income. I said, well, that's interesting. I said, wait a minute. So you're telling me if I paid, I don't know, $1,000 for this site and then started running it and sold it, let's just make up a number, sold it for $1 million, it would be capital gains. He goes, that's right. But because it only cost me basically nothing, then it's all ordinary income. He goes, that's right. I said, that doesn't make any sense. And what he pointed me to was a part of the IRS tax code. And I'll tell you right now, I'm not a tax guy. So this is just my reading of it. I'm not a tax professional. This is not tax advice to anybody listening to this podcast. There is a provision in the tax code, as I understand it, that says if you create a copyrighted work and then later sell it, it's treated as ordinary income. So I'm thinking, okay, so if I write a book, for example, then I sell the rights to the book to someone, ordinary income. Or if I create some music, a track, God forbid that I would try to create music, but if I did and I sold it to someone, ordinary income, I said to my accountant, we had this discussion, I said, okay, and I could see that applying to the content. But the content is a very, very small piece of what is sold. In fact, if you were going to allocate the purchase price, almost nothing would go to the content, which may seem a little counterintuitive. But the database, the code, and frankly, the domain name is without question, 95+% of the the purchase price of a blog or a website. And he goes, yeah, it doesn't matter. I said, well, can you point me to something? Can you point me to some research? I get your opinion. What's it based on? Couldn't point me to anything. So that was the first evidence that when it came to tax research, he wasn't the strongest. And I ended up talking to a tax lawyer at my firm and some other bloggers who have sold their blogs, and I concluded my accountant was wrong. He was just flat out wrong. It would not be all ordinary income. Now, I kind of dismissed that at the time, though, because I didn't sell the blog, right? So it's like, well, all right, I'll cross that bridge when I get to it. But really, that should have been my first indication that when it comes to analyzing, other than everyday tax issues, maybe he's not the strongest. Nice guy, by the way. I think he probably does a fine job on my tax returns. But when it comes to these sorts of issues, not the strongest when it comes to research. The second red flag for me was this whole issue with the backdoor Roth, which actually came up in 2013. And I'd gone to him every year for tax planning. We talked about the best way. Should I be a pass-through LLC? Should I be taxed as an S corp? Should I look at a defined benefit plan, which is another retirement option for self-employed? What's better, a SEP IRA versus a 401k? And the backdoor Roth never came up. It should have screamed at him that I should be doing a backdoor Roth. Now, this was a little different. He didn't give me wrong advice. He didn't say, for example, you can't do a backdoor Roth. It just was something that he never even mentioned. And now I know, in part because he doesn't know what one is, which is another really big concern. This is something that a tax accountant should know. This is not complicated stuff. So as I think back on this issue, I think, I should have made a change of my accountant several years ago. So in that sense, I'm not going to take responsibility for the incorrect advice he gave me. That's his responsibility. But as I try to learn from this situation, I have to say to myself, I should have made a change several years ago, and I should have made a change when I believed that his ability to analyze tax issues that are perhaps something other than you might encounter from day to day just wasn't strong. It just wasn't strong. And I should have made a change back then, and I didn't. Now, so of course I am making a change now, and I've talked to my new tax accountant. And by the way, as part of trying to learn from my mistakes, I quizzed this new accountant. I asked him about a backdoor Roth and if he knows what it is. Without telling him any of these issues, I asked him whether the $52,000 SEP IRA limit would be limited by my 401k contributions at work. And by the way, he immediately said no, because they're per plan, not per person. So, I learned from my mistakes, not only in making a change in my accountant, but also in how I hire my next accountant. And so that was an important thing. And so this whole thing required me to, one, take responsibility for my own decisions, take responsibility for those things that I can influence, and to be honest with myself. And so trying to do those two things, those were just two of the 12 keys to making smart financial decisions I talked about in podcast 89. I re-examined how I handled hiring my tax accountant, working with my tax accountant, responding to tax conclusions that he reached that I thought were less than well thought out and less than well supported. And so, being honest with myself, I looked at the things that I could have done differently over the past several years. And so that's what I've done. And as I said, I've made the first thing, I'm doing a couple of things. The first thing I'm doing, of course, is changing accountants. And that's what I'm in the process of doing. Now, you might be thinking, well, Rob, you're a lawyer. Couldn't you sue your accountant? Well, I probably could. You say, are you going to do it? Probably not. There are a lot of reasons for that. Part of it is just, it's funny, as a lawyer and a litigator, at a personal level, litigation is a terrible way to resolve things. By and large, I understand that sometimes it's unavoidable. And if you were in my situation and you made a different decision, I certainly would not be critical of that. But I think it's unlikely that I will do that. I'll just learn from my mistakes and move on. Now you say, well, what does this cost you? Well, let's think about that. So I calculate that from 2010 through 2013, I've missed out on about $67,000+ in SEP IRA contributions. So the first thing that I'm losing out on are the tax savings at my marginal tax rate from those contributions. And I'm losing out on the tax-deferred growth of that money for 25 plus years. So I haven't actually fired up the spreadsheet to calculate a number, in part because it would probably be too painful. So that's the first thing I'm losing, not an insignificant amount of dough. The second thing relates to the backdoor Roth. Now, again, he didn't give me incorrect tax counsel on this issue. It simply failed to make what I think is an obvious move known to me. I think it's a different issue, but nevertheless, if I'm paying a tax accountant, I'm expecting that he or she will have my back and be able to recommend these sorts of tax planning strategies that are really, really simple. And so had I put away the IRA max each year from 2010 through 2013, 10, 11, 12, 13, 4 years, call it roughly 20 grand, would grow for 25 plus years, and I would not pay a nickel on the dividends or the capital gains. Another very expensive mistake. So not a fun day here at DoughRoller headquarters. It tells you, I'm someone that reads and studies this day in and day out, and mistakes still get made. That's why it's so important, I think. And one of the reasons, actually, it's funny, not all of this, I wasn't aware of all of this when I recorded the 12 keys to making smart financial decisions, including taking responsibility and being honest with yourself. But, God has a sense of humor, and now I get to apply those two things to my own life. Well, there you go. So what am I doing? Well, as I mentioned, I'm changing accountants. The other thing I'm doing is I'm examining other parts of my business for the same problem and making changes. So when I'm hiring folks, whether it's an accountant, a lawyer, I do hire a lawyer to do my wills and trusts for my wife and I, because that's not the kind of law I practice. I have other service providers for my business. I am going to be very sensitive to their performance. And if it's not meeting my standards, I'm going to make a change. It's as simple as that. Now, I'm not suggesting that people can't make mistakes. We all do. I'm not suggesting that I'm going to demand perfection from other folks, even any more than I can can claim perfection for the things that I do. But I'm going to be looking at the quality of the work, and if it doesn't meet my standards, changes will be made. So this is going to apply far beyond just my accountant. And the third thing, and I think this is equally important, is I'm going to be examining and re-examining the quality of my own work. If someone held me to that same standard, would I still be working for them? In some ways, I view my job here as working for you. So I'm going to be examining the quality of my own work. And does it meet the standards that I am going to be applying to others? I think that's only fair, and I think it's the right way to do it. And so I'm going to be re-examining the quality of my own work, not only in how I produce content for this podcast and for my blog, things that I still view as a hobby, but everything, every part of my life, whether it's with relationships, managing my own finances, my day job, the way I run and manage my home. We are constantly hiring contractors and people to, for all different kinds of things. I've actually had floor people in my house because our refrigerator sprung a leak and ruined our floor and the ceiling below it. So I've actually got the floor torn up of our kitchen and fans on the subfloor trying to dry it out. Lots of fun. But these are contractors that I'm managing, and I'm going to be applying these same principles to how I manage contractors. So I've learned a lot from this very, very expensive, sad story. And I hope you learn a little bit from it as well and can examine your own circumstances and the folks that you hire to help you and how you perform your own work. I think, it would have been very easy for me to have just blamed the accountant, and certainly he has some culpability for sure, but to just blame the accountant and say, well, it's just all his mistake and moved on, and I would have learned absolutely nothing from this experience. And this is, I think, a perfect example of how you can and should move beyond just that sort of surface analysis and say, fine, he did make a mistake, but what could I have done differently in the past to maybe have avoided that mistake? Because yes, it's his mistake, but unfortunately, I'm the one that's going to suffer the financial consequences from it, and I want to avoid repeating that again in the future. So what can I learn from it? And that requires taking responsibility and being honest with yourself. That's what I've tried to do, as I've kind of outlined for you in today's podcast, and what I'm going to do about it. Hope you can apply this to your own circumstances and your own life in a way that can make things a little bit better. Well, there you go. That's my sad story. And that brings this podcast to a close. As always, shoot me an email if you have questions, dr@DoughRoller.net. I will say that it's taking me a little longer to respond to email because I'm getting flooded with them, but I do get back to you. It may take me a few days, may even take me a week, but I will return the email. So love to get your notes, your questions, your comments. You can just, again, shoot those to dr@DoughRoller.net. And that brings this podcast to a close. Until next time, remember, the best thing money can buy is financial freedom.